The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem. Joining us now to discuss the crypto markets is Eric Chen. He's a co-founder at DeFi exchange Injective Protocol. Welcome, Eric. So we've got a big week for the financial markets this week. The Fed is expected to approve another 75 basis point rate hike. Major tech firms are expected to announce second quarter earnings and second quarter GDP growth. That rate is expected to be released. So I wonder, how is that impacting markets? I see, crypto is down in traditional markets. It's kind of all over the place.
Yeah, I think overall crypto trends pretty well with the equity market, but right now they're relatively more in a risk-off mode. But I think if you look at the futures on most of the major indices, it's actually up this morning. So I think overall it's a positive expectation, and given that the base case of 100, or like the worst case expectation of 100 basis point is now out of the question and going for 75, overall the market is relatively in a more optimistic spot than it was a week or two ago.
Do you think it is already priced in terms of the bottom, or it's more of a wait and see?
Always wait and see. You never know where the bottom is.
Okay, fair enough. But with the Fed and the estimate or the prediction is a 75 basis point rate hike, it's thought after this front end kind of hawkishness it might slow down. Your thoughts on that?
Yeah, I would say that given the most recent CPI figures, it definitely wasn't, the prettiest one. So a lot of people were actually expecting a 100 bips hike. But right now, as of yesterday or today, there's been more signal towards 75 and kind of slowdown after that. So I think the market is overall kind of moving into a more rational and, less risk-off way in the next few months.
What are your thoughts on the performance of DeFi tokens compared to our majors, Bitcoin and Ethereum? How are they faring?
I would say like the overall sector currently, especially with all the centralized provider and custodial providers insolvency issues, it's creating a very, very strong kind of case for DeFi and promoting a lot of users to switch over to DeFi platforms and networks and protocols. And basically, even Celsius having to repay most of the DeFi loans before everything else is a very strong showcase that code is law at the end of the day. And I think even though the overall market for digital asset and the less mainstream ones has not been performing as well as the mainstream the top 2 or 5, but certainly this is a growing industry and it's going to grow much faster than the mainstream ones in the long run.
Interesting. So DeFi is supposed to offer transparency over collateralization and automation. It's supposed to be safer than traditional finance. But of course, as we see these loan defaults and solvencies work their way through the system, from any firm that had direct or remote exposure to Terra USD, some DeFi systems appear more stable than others. So I wonder what works and what doesn't work.
It's always a parameterized risk when it comes to DeFi mechanism design. Generally, it could be in a case that some of the DeFi protocols are designed to be more risk-off, more traditional, much easier to price, and some of them, could have security issues and also, mechanism design issues that was kind of showcased through the Terra incident. And that being said, I think the failures are, being much more highlighted in the space in general, and even to, like the non-crypto space compared to the success. And if you look at Compound, Aave, and all those lending provider compared to centralized ones, there were never, concerns or risks around solvency or bankruptcy because code is law at the end of the day, and it's very much of a transparent, over-collateralized, and most importantly, composable system where liquidity begets liquidity within DeFi and creates a whole ecosystem of composable finance.
So, Eric, maybe you can explain to folks what separates DeFi systems that failed, like Terra Luna, from those that held up, like Aave, like Uniswap.
Yeah, there's a very big difference in terms of a sound mechanism design versus a risk-on mechanism design, or sometimes even a flawed mechanism design. And at the end of the day, for any type of growing sector, for any type of innovation, there's a probably more than a 50-50 chance that something will succeed in the long run or something that will fail, from a mechanism perspective. And this is certainly the case for DeFi, where there are constantly people trying some new financial primitive, trying something new mechanism to kind of incentivize growth and also to provide more long-term sustainability. But that being said, there's not all of them are going to make it through the finish line, and sometimes there could be some of the minor flaws in mechanism design or some major flaw that causes like a catastrophic failure. And I think generally speaking, for specifically, Terra collapse versus other stablecoin, it's really about what's relatively more riskier on the innovation spectrum versus something that's a little bit more risk off, like compared to Aave and Compound, which is not as innovative, relatively speaking, in the DeFi sector compared to most of the newer, I guess, like DeFi protocols. And that is kind of the risk that players and users should definitely expect, because after all, something that's new doesn't mean that it's always better. It also means a potential for failure.
Right. When you talk about risk off, I think of more centralized human monitored players like Celsius and Voyager, right? If you were an investor who wasn't so comfortable with decentralized finance, maybe you could use Celsius and Voyager as a place to park your crypto and earn some yield. Yet those prove to be incredibly more fragile than those largely automated systems. And I wonder your thoughts on that. Why is that?
I think this is absolutely understandable, because it's very hard for people to adopt a platform where they don't understand it. And the irony here is that, oftentimes Celsius and Voyager do end up acting as like a centralized custodial front end for deploying into, DeFi protocols. So this might be actually a great opportunity for a lot of these, more traditional lenders to realize that there's a very robust, very secure, very transparent, protocol and financial primitive in the crypto space that's earning yield, whereas they're, giving money to a centralized provider with solvency risk, with, reporting issues that isn't necessarily as secure.